Good morning, Ken. Uh,
Morning,
so-
everyone.
So the first thing that we are going to address is a change in leadership or decision making in for this committee, and that is that we have, whether you knew it or not, Commissioner Bershauer was in fact our liaison from the county and the commissioners for this meeting, and Commissioner Sterrett is now in that position, and you know she's always been very involved, and it's a not a big change because all the commissioners have been involved and have paid attention to what's going on. But I welcome Commissioner Sterrett in the group. She now gets to vote. She was always trying to vote, so now she finally gets to vote. And so now Commissioner Bershauer, you can't vote anymore. So I'm sorry about that.
I'm perfectly fine with that. I will be the fly on the wall.
All right. And the next thing we have on the agenda, I believe, is the I'm gonna put my share screen. So what are you all seeing? You're supposed to be seeing a different thing. Oh,
We can see the agenda.
can you? Okay, because I've seen something else. Okay, you can see the agenda. As long as you can see it, that's all that matters. I've seen the my mail, is what I'm seeing. Okay, so the next thing is approval of the minutes. Now, it's quite a while ago, but so you've had a lot of time to read them, and I'm sure you have. So I ask if there's any discussion of the minutes, if somebody wants to recommend that we approve the minutes.
Chris, I'll move approval of the minutes. Sterrett.
Okay, thank you, Commissioner Sterrett. And all of those in approval? Say aye. Aye. I guess everybody did. I'm still cleaning this up because it just doesn't seem right. All right, so you're seeing this. When I do that, that's what you're seeing, right? My squiggly.
Yeah, we can see your cursor moving over the agenda, Chris.
All right, thank you, because there's some strange way that this shows. But anyway, so the next thing I wanted to talk about is here we have, for the Investment Advisory Committee, we probably should vote on this to approve this, to send it on to the commissioners to approve the change in membership, even though the commissioners were the ones that make the change. Does that sound right to you, Mary?
Chris, I think, and Ken can correct me if I'm wrong, I think since the liaisons were voted on at the board level, I don't think this is necessary, but it wouldn't hurt to do it.
Okay, all right, but I don't need it to send it on to you guys for approval, but we
No.
can approve it. Okay,
Correct.
so would anyone like to recommend that we approve this change in the membership of the committee?
So moved.
Thank you, and all in favor?
Aye.
Great, thank you. I do have, and I was hoping that she would be here. There is going to be another change right here. Katie is moving to the Midwest. And she told me when I talked to her that she wanted to continue on the board until they make that move, which I believe is in June. So she would be at a couple of more meetings. And she's moving back to where she was living before they came here. And I wish her well in that move. She hasn't been an active member in the board in terms of her input, but she has paid a lot of attention. And I know if she has a question, she would either ask at the meeting or she would contact me. So she has been involved. So, and I appreciate that. So if she doesn't come to another meeting, I just wanted to say that we appreciated that she stepped up and volunteered to serve on this committee. And she was a candidate last time for the position of treasurer, which is why I became aware of her. And she graciously congratulated me and accepted this position, which showed that she really did care. So hopefully we'll see her another time, but if we don't, I just wanted to thank her publicly for her service. But I won't be recruiting or suggesting that we recruit for anybody until she's officially off the board. We don't have to replace her because we have a swing in what we need in terms of we can have a committee of 5 or we can have a committee of 7. It just depends on this being such important work. We need to make sure that the people that we have on this committee have the knowledge to understand what we're talking about and actually give good input. So that will not be a quick replacement when we do it. So that's it for, it's not it for Katie, but I did want to bring that up. So we approved those. So the next thing I want to talk about and is the dividends and interest, and this is just for January because I did a report for the quarter and you all have that. So I thought there's no point talking about what happened in December in the middle of February. So I did this. This is a monthly report for the month of January. So LGIP was increased February 1st. So the numbers that we have are all based on the old rate of 5%. They changed the rate on February 1st, so it's not reflected in the numbers yet. Our old, which 5.2 is really competitive rate. The portfolio yield is 5.132 and the book yield is 4.305. I'm really happy with all of that right now. And then in terms of what we actually earned, we earned in 1 month, we earned $78,000. Sorry, so all of a sudden I said 78 million. Well, that's really great. That is actually what we had in those portfolios is 78 million to earn the interest and dividends. And excuse me, one of the side effects of the way I spend my days these days is that my voice is leaving me. So can you all hear me okay? Okay, thank you. So the treasury yields at the end of January and the beginning of February were pretty good still in the short term, even though rates in general have been going down. And we are right about in this range, which is a 6-month range. So we're very competitive with where we are right now. And then when we get out to the 30-year, of course, it's still low. And but it went up for a while and then it came back down. This is our inflation chart for just a comparison to where we are with inflation. We were 3.4. I believe we're down to 3.1. Is that correct? Come on, you guys, speak up. Anyway,
That was the most recent reading, Chris, that just came
Yeah.
out, I think, a couple days ago.
yeah. I had the reason I'm confused is because what I was studying is the monthly change in inflation was actually a little higher than the month of December, which is a concern. The annual rate year to year is lower than it was in December, but the monthly is a little bit higher. And that's primarily because of items like food and services. And so what we're looking at is kind of in my opinion, is kind of a hidden creep in some expenses that have been outweighed by the decrease in some other areas that are significant to our overall spending, such as gas and fuel, which gas has gone down. So we're not out of the woods at all. with this inflation, and it will be people were all excited and everybody was thrilled about inflation going down, and there's a little bit of caution out there now that maybe it's going to creep back up if we don't really stick with it. So chances are that depending on what happens in the next couple of months, we're not going to see rate increases from decreases from the feds. At least until the most recent that I read was May is the earliest anyone expects those rates to go down, which is not a big factor for us, but obviously it affects overall. So in the end, if you're a borrower, it's not going to get cheaper, which is what people were hoping for. This is our actual report. And I'm gonna try and get this a little bit bigger. Oh, there it is. Okay. What we have here is the 78 million that we have in all combined, everything that we have, the bank, the money market, and the bonds. So that we have a net unrealized loss of 640,000. Now we were at 2 million in unrealized loss 6 months ago. So we're gradually, our investments as we reinvest are going up in terms of what we're receiving. And that combined with the market going down has kind of tempered this. But, so much of our portfolio is short-term that hopefully will cross over into no unrealized loss, but not until we get rid of some of these longer-term bonds that I don't think we should get rid of at this point. So we're looking at a duration of overall of 0.47 and 0.7 for years to final maturity. And our average credit rating is still very solid because we're investing in primarily government bonds, US bonds, as you can see. Now, I wanted to say something about, we had a discussion before about we shouldn't be investing in municipal bonds. And I want to add one thing to that is that if the rate on a municipal bond is higher than a corporate or an agency bond, there's really no reason not to invest in those. And so I like the state of Oregon money that we have, we invested in that at a time when that rate was higher. It was very competitive. And so if I do invest in a municipal bond, that's the reason why. And state of Oregon tends to have good rates. I haven't bought any municipal bonds, but they're getting more competitive again. And so you might see that in the future. The others are all, well, then like community college is same situation. Although none of those bonds are new in the last quarter. And so this is the income broken out by interest, dividend, and type. This was for last quarter. No, last month, sorry. And so it's pretty high, pretty nice. And I mean, if we could earn that every month, that would be really, really nice for the budgets throughout the county. And the trade activity, I wanted to address when I buy, particularly when I buy home loan bonds, they are most often callable. And what we're experiencing now is, I see Kevin. Kevin, do you have something to?
Oh, I think Commissioner Starrett, did you have a question first?
Oh, I'm sorry. I'm not doing real well with my looking at that. Sorry.
Actually, this can wait. Something came to mind. When we look at that 78, so we're looking at that 78 million, does that comprise large amounts of money we've yet to expend? I know we got some ARPA funds that didn't go out the door. We've yet to cut checks, or they're still, in negotiation, those types of things. Is that something that we are putting in investments of any kind, or do we keep them? This might be a Mike question. Do we keep them sort of sitting at the ready?
They are invested. All of that money is invested, which is why I keep it very short term. So as a rolling amount of funds, we always have the money in LGIP ranges between 18 million and 25 million. That's always completely liquid. Then if you look to the other ones, that the corporate only, or not the corporate, but the bonds only, that's this 51 million. And that 51 million is still mostly, if you go down to here, you'll see bond maturity. 89% of our bonds are maturing in 1 year or a shorter time period. So that's very liquid. Does that answer your question?
So, for instance, if we were to write a check for any of the outstanding ARPA grants or any of the other large chunks of money we've yet to expend, that would come out of that. And it is liquid enough for us to do that, but we are still getting interest on those large amounts of money.
Yes. We
Yep.
get interest on everything except for the money that's in the US Bank.
Okay, thank you.
And I thought I heard Mike interjecting.
Yeah, I agree with what everybody said there. The ARPA money in particular, it actually has its own LGIP account. So that is, and when we cut a check for anything for that grant or other grants, we have next day liquidity. So we'll move the money immediately the day before into the checking account to cover that check. So we keep our checking account as low as we can within reason, and keep everything that we need for the next month or so in LGIP, and everything else Chris has access to for investing.
Okay, thanks, Mike. Helpful.
Yeah. And if Mike, I would assume that we wouldn't write a large check today that Mike didn't know about long before this. So if he knew something was coming up, he would let me know.
Yeah,
And,
we do a cash projection on a daily basis to know what's going to happen in the next day or two or three in the checking account. So we make sure we keep as much as we can in LGIP until we actually need it.
So Mike, we have 27 million in LGIP in this report. Is that include the ARPA money that's separated, or is that a separate account that we're not seeing?
No,
Right.
and that is it's in the LGIP account of Chris.
Okay.
if you see it here, it's the 3 million
Mhm.
221.
Yeah.
That's
Oh, there
our,
it is.
so this
Yeah.
breaks this out better for everyone to
Okay.
see where
Yeah.
all that money is and which account it's in. And so we have the 27 million at the end of January. Of that, 23 or almost 24 million is the county's to use as the county sees fit. And then this is designated dollars for the ARPA funds, which I would assume will be gone and spent by the end of this fiscal year.
Yeah, I think
I,
most of those. Oh, sorry. Go ahead, Ken.
I was just gonna say that the ARPA account, because we have just over $2 million going out for childcare. So that's correct. Most of those funds remaining in our ARPA account will be spent by the end of the fiscal year.
Where's the broadband money being kept? Because that was just over 3 million.
The broadband money's a different category because that's actually up in the other LGIP account, the 25 million. There's 2.2 million that came to the county via the state ARPA allocation. It's not included in our ARPA account because I don't have, I report to the state, but that, the ARPA account that we opened in LGIP was for our direct allocation, which a few years ago was 21 million. The 2.2 million for rural broadband is in our general LGIP account.
And Kevin, you had a question as well.
Yeah, I was gonna change the subject a little bit, so if there are more questions about LGIP and ARPA, then.
Okay.
But my question was about duration, and if like you said, we're not expecting interest rates to change here in March, but potentially May or June. Have you thought about increasing duration to compensate for having lower interest rates, and LGIP would go down as well, going out to a year, year and a half in terms of duration? Just wondering what your thoughts are.
Yes, I have, and I need, for reasons that I can't discuss, I need to keep the account as liquid as possible until some things have clicked into place for the county. But what I've done right now, and that's why the LGIP is a little higher than normal, is because it's earning 5.2, and if I go out 2 years right now, I'll get 4.8. And I don't see any reason to give up 5.2 for 4.8. If in fact I'm going to need that cash in that 2-year period. And the other problem, if I want to go with the callable bonds, I can get around 5.2 on a longer duration, but I've just had 5 bonds called that I bought in the fall. And I'm looking at, when I look at my schedule of maturing bonds, a lot of it is callable before it matures. And so we're going to have a lot of extra cash coming back, and I'm not really willing to tie it into something longer than 2 years. And if I can get 5.2 from LGIP today versus 4.8 for 2 years, that doesn't seem to me, for the purposes of the way the county manages money, it doesn't seem like it's a good switch. Does that make sense?
Yeah, I guess that I get my question would be, at some point it could be worth taking a lower interest rate to lock it in, where, because LGIP seems pretty tied to the Fed funds rate. So if, by the end of the year, that drops 0.5%, that would get below a, 1 or 2 year. And so that's the only question, is if there's a trigger at some point when we take a portion of the portfolio and go out a little bit longer, just to try to lock in those rates.
Yeah. No, I don't disagree with you. And that's a question that, I have to deal with all the time. If I look at, I'm trying to,
I'd like to just piggyback on Kevin's comments there. I think taking some money a little bit longer, even if it's 4.8, probably makes some sense, because if the Fed starts lowering, LGIP will be below 4.8 really fast. Is locking up some of it. But the other comment, it's your portfolio to manage, but I'm not a fan of callable bonds. The issuer is always the winner. As the buyer, you're selling an option that doesn't go in your favor usually. They're good tools, pick up more spread, but cash flow certainty is probably going to be important going forward as well. So just my thoughts.
no, I appreciate those thoughts. And the one thing, and I actually wanted to ask you guys what you thought about this strategy. One of the brokers who I'm working with is selling callable bonds as short-term bullets, and that you buy the bond and it's paying more. Let's say it's paying 5.3 today, and it's callable in 6 months. Then really you have a short-term, you have a 6-month bond. If they don't call it, then you've got a really great rate for a longer period. So that has some appeal to me, but what do you guys think about that?
I think, Chris, just, again, you have the reinvestment risk. I mean, I'm not saying it's not a good idea if you're able to get that higher yield versus a comparable 6-month option. But just sort of assuming that it is called, then what is the prevailing interest rate environment at that time? And what kind of investment can you make? So that, to me, that's the bigger consideration.
Yeah, it's an interesting idea that appeals to me because my goal was to keep the bonds really short right now. And so the only downside, if I'm looking for really short-term investments, the only downside is that they didn't call it and I'd have this high return for a longer period of time. If I want to reinvest 6 months from now, it gets called and it's gone down to, I don't know, 4.5 or something along. I don't think it's going to go down dramatically in the next year. And since we're thinking so short term, what I have to look at is what's going to happen with the interest rates in a year. I'm not comfortable because we got burned before doing this to go out farther than 2 years. But I did buy a couple of bonds that have gone out that long, but they are callable. And so it's right now I'm sitting because I'm kind of trying to accumulate some cash for the county. And so anything longer than 6 months is really not appropriate right now. So we just need to look at that. Mary Starrett, your hand is up.
Thank you, Chris. So I wanted to go back to something that Jim said. I know the purpose of this committee is to really get input from folks who know the business. I don't. So anytime one of you weighs in on something, I take it very seriously. So Jim and Stacy and even Mike, anybody else, Kevin, want to address the question that Jim brought up about callable bonds and what that looks like in terms of our risk exposure, and just so that we get, a wise person takes counsel from many, and I'd like to make sure we're doing that here. So anybody have any thoughts? Because I don't know what you guys know.
Right. I think you guys made it pretty clear what you think, but if you have something more to add to that.
Yeah, I'll just follow up a little bit more. I mean, they're not bad. They're just, you're just giving up cash flow certainty. So the issuer has the option, and sometimes they come back when you don't want them to, right? So an allocation of the portfolio is fine to being callables, just like I think Kevin and I expressed it, an allocation into maybe some fixed rate treasuries out a little bit longer just to protect yield in a down market. So it's all about diversification, I think. But I'm impressed with the yield that Chris has been able to do on the portfolio. It's really impressive how quickly she's turned the rates around. So good job.
Thank you. So I'm going to show you, this is a report that I made for me, so that I knew what percentage we had in callable bonds versus non-callable. Now we're not supposed to have under state regulation more than 35% of the portfolio in callable bonds, for just the reason that everyone's mentioned, that you could, all of a sudden everything gets called away and the rates are really low and you take a real hit. Well, these are the callable bonds that we have. And this is their final maturity date as compared to their next call date. And it's not a big difference in most cases. So I don't feel that there's real risk for these bonds to all of a sudden get called away when they're like this one here, let's say it's maturing on 11/18 and it could get called away in May. You know, that's not a real problem. Now, the coupon rate on this is 1%. They're not going to call it away. I wish they would. But these are bonds that were bought when the rates were really low. When we get down into here, then you've got a bigger, like this is callable is 11/27. I mean, maturity is 11/27. It's callable in February. That's going to get called away at 5.45. So this is going to go. So with the current rates at let me see where I've got. I'm going to go to the Wall Street Journal to look at the current rate today for the various. Things are going slowly today. So if bear with me while I navigate to where I want to go. So this is the rates as of right now. So if I'm buying a 6-month bill, I would earn 5.338. I wouldn't earn that much, but around 5.338. If I go to 2-year, I'm down to 4.645. 3-year, 4.427. Now that's a 1% difference. That doesn't make sense to me to sacrifice a full percentage point because I think that LGIP is going to go below 5.2. And that's a decision that I have to make, and with your input, of course. But you know, do we really think that the short-term rates are going to go below 5.2, significantly down as much as 1%? And my bet is it won't. And so that's what I look at. It's like, well, you know, do I want to go that low in order to protect myself against these rates dropping a lot? So what do you experts say out there? Because I do want to hear. I mean, that's just my logic.
I mean, I think also going off what Jim said, I think I was just more saying diversification is good and no one knows what's going to happen in terms of the rates necessarily. And so having, you know, some exposure to short term, some exposure to, you know, 1 year, 2-year, just kind of hedges the bet that, you know, yes, we're giving up a little bit of return, but, you know, some of the like future markets and treasuries think that we could see, you know, 75 basis point drop this year in the base rate. That would be significant enough where if you could, you know, if you're reinvesting in 6 months and things are down 0.5%, you know, that's also, there's a risk of as interest rates go down that you are behind the curve.
Right. And we certainly have been there. I mean, we've been on both sides of that. So you know, so this is what I look at this every morning and say, oh, what's the trend? What's going on? Here you can see the trend. It was really high back in the middle of February, and now it's down considerably lower. And so this is a you know, what I also look at is look at all those beautiful white men. No, there was a woman there. Okay, so this is exclusively the Yamhill portfolio of bonds and not including LGIP. And I look at this report, not every day, but most days. So I know what's maturing and when it's maturing. And what you can see here is that we have a lot of bonds that mature in 25. We're not all just 24. Look at all that. And the majority of our bonds are in government, and they are in fact longer than 6 months. So we are doing that already. And some of these bonds were bought, you know, in the lowest end. And but they're still callable, but you know, they're not going to get called. So as you could see, we're not really all invested in just 6 months. We do have a portfolio that when it's blended, it looks like it's 6 months because it's including the LGIP when we look at the report. And this is as of today, not as of last month. When we look at that, it's all of this is the state of Oregon. That's the money fund. And then it starts going down this way. But if you have you guys like seeing it on the live instead of in a report? So it brings our average final years to maturity to 0.659 because it's including 27 million that's in the money market fund. And if you look at just the Zion, our average to final maturity is 1 year. Does that help? So, and then when you look at, let's say, look at year to date, let's do that. And this is, we've had 5 million down here, $5 million that has been called. And I gotta get rid of that. I don't want everything in there. This is just since this is in the fiscal year. So if we review the report, this is what we've done in terms of trading. And I'm welcome. I like talking to you about this. I'm not feeling defensive, just in case you were wondering. So we have purchased. This is what we have purchased since the beginning of the year, since federal, down here to, and that's all government. And then we've had 5 million of that called back. And then we've had all of this money has matured this year. So I think it's fairly well balanced. How does that look to you guys?
To be honest, Chris, it's a little hard to read. It's a little small, but
It is still
but you did a nice job of explaining it. So thank you.
Yeah, so that's my rationale, and I'm really glad you guys have brought up what you have, because that's certainly important to look at that. I think one of the biggest factors is that I'm investing as a government agency as opposed to, because my #1 directive is safety of principal, and my last is income. So I have to think of it as backwards as to what I might if I were in a private sector, or if I'm trying to manage a loan portfolio like Jim is, where his job is incredibly difficult. I just, because he's got long-term loans out there at all different kinds of rates. And then to try to predict whether or not, I mean, 0.5% for an organization like Jim's is huge. And for us, it's not, because we don't have that much money. Plus, we're not having our portfolio mature in the same way or for as long as term. Okay, I'm gonna go back to, and this is in the report now. I, for some reason or another, and so I want to go to, this is about the LGIP that I did want to point that out, how much of that is liquid. And then if we go on to the report again, I don't have a slide for this, but what I did want to talk to or address is, well, here's the trading activity for last month. And I could try and make that bigger. So those are, we got 3 called last month and 3 matured. And this is what we bought. Sorry if I'm being repetitive. But the other thing that I wanted to address in this meeting is we had a little discussion in our non-meeting last month about the allocation of funds. And I asked Mike if he could explain, for those of you who weren't here, the question is if we take a loss or if we have a gain, whatever, who gets most affected by an increase or a decrease in interest rates and dividends of the departments? Because with the understanding that all of this money is allocated in some fashion, it's not just money we're sitting on. And Mike is certainly the one who understands that the best. So Mike, go ahead.
Okay, so I'll just explain what we do, and I think that will answer the question. And it's pretty straightforward. So we have 2 accounts in our balance sheet that are holding accounts. And one is for the pool and one is for the bond. One's called bond distribution, one's called pool distribution. So during the month, all of the investment income for the pool goes into the pool account. All the bond receipts that we get for interest goes into the bond distribution account. And then when we get expenses, we charge those to those same accounts. So the pool has some expenses that we have to pay for trading transactions. And we also have to pay Sweetwater, sorry, not Sweetwater, that's a restaurant, Clearwater. And as well as Zion's Bank, we charge those bills against the bond distribution account. So at the end of the month when we close, we know how much we want to allocate out as net bond investment income and net pool investment and pool net investment income. What we do is once we get all the bank account activity handled for the month, we run a report, and we do pretty much a straightforward. We look at all of the cash. When I say cash, it's really a combined of the pool and the investments and the cash account into $1 amount by fund. So I'll just say, if there's, Chris said there was $78 million. That $78 million would be basically exists in every one of our funds we have. And I can't remember how many we have, maybe 30, something like that. And we'll just take the cash and investment total by fund for the beginning of the month and the end of the month and average it. And then we take that percentage. So if the general fund, let's say, had 25% of the entire cash and investment pool is in the general fund, it would get 25% of the bond distribution account and the pool distribution account. And we just split it up that way. And then we do a journal entry, get it out of those asset accounts or the balance sheet accounts, move it into the interest or bond income in each fund. There are 2 exceptions to that. The first one is the investment account. We do not allocate any amounts to our trust accounts. because the trust accounts are sort of by definition, in particular, the trust account for the property taxes is very liquid. We get that money in every month. We send out that money every month to all the taxing districts. It's often a big dollar amount in the investment or in the pool because we're getting hundreds of millions of dollars in November and December. So we do not allocate bond net investment income to the assessment taxation's trust fund account 701. That's one of the exceptions. And I know I had another one out there. Let me think. I know a question came up earlier about how does US Bank handle their fees, and it's true, US Bank does not pay interest, but we get what's called an earnings credit. So I'm assuming Jim's familiar with that concept, and we only settle up once a year. So every month we are earning an investment credit or an earnings credit at US Bank. Oh yeah, there we go. There's, by the way, the one of the bond allocations for October. And
Right.
that if you go back to the tab before that, the Smart View tab there, right there. Yeah. This is the beginning and ending balance of the cash and investments total for each of the funds. And then we just take the average that is there in column E, I guess, and we're going to allocate out on a percent of that. So that column E goes over to that third tab, October 23rd bond allocation. You hit that third tab there.
Oh, sorry.
There you go. So that's the exact same column that was in the prior tab. And then we take a percentage. You don't see the percentage, it's just part of the calculation, but it's in the formula. You can see there in the cell. And then the very top row, C8, that's the net bond interest income for that month of October. And that's how we allocate that out. So it's straightforward. But back to the US Bank. So we get an earnings credit every month, and then they charge us bank fees every month. So as the months go by, sometimes we have more earnings credit than fees. Sometimes we have less earnings credit than fees. But at the end of December, they will take the net of that and either charge us for any excess expenses in excess of earnings credit. And that's what they do. We don't get any earnings credit if that's higher than the fees. That's just their way of giving us a cut or a break on our fees as we keep money in the US Bank checking account. So it's not interest income, but it's an earnings credit. So we reduce our fees. We just did the one for 23, calendar year 23. I can't remember what the number was, but I just don't remember off the top of my head. I see too many numbers. I don't memorize anything anymore. I just might get it wrong, but we did have to pay US Bank some dollar amount. We split that payment up between two categories. The first category is for all the general operating funds of the county, and that's the normal county checking account. And so we take that bank fee, that net bank fee for US Bank, and we reduce that for the interest income for the pool allocation, we call it, when we actually do the January allocation. That's how we handle that. So it's just an efficient way to allocate it. Net is one number versus two allocations, but the result will be the same. We do the tax account allocation because we have that tax lockbox. We isolate those fees and the earnings credit for that tax lockbox and charge that right to the Treasury Fund 701 because that's just for property tax distributions. So it's not too scientific. It's kind of straightforward. I've tried other allocation strategies. I have one I tried with Oracle, didn't work. We had some, as Chris knew, we had some problems early on because the allocation was horrible. I said, this cannot be accurate. And I finally figured out Oracle wasn't working the way I thought. So we had to retroactively go back to the beginning of Oracle and reallocate some of those interest things. But it's all leveled out now. I think we're stable. So any questions on that?
Mike, do you recall what the earnings credit rate is?
No, they've of course increased it lately. Boy, if I had access to my actual, I'm obviously not here at work. I'm in Colorado right now. If I had access to the file, I could pull it up and tell you in a heartbeat, but I can certainly send the information to Chris. I could tell you what the total interest credit was, what the fees were, and what the earnings credit rate was as well. So I can
Yeah,
get that.
I was just curious about the rate, just, thank
It's
you.
not huge as you would expect. It's, you know, it's not 5%. I'll
No.
tell you that right now.
No.
So
Doesn't make a difference in our overall cash plan.
you should say that again. The
I
earnings
said it
credit, no.
doesn't make a difference in our overall cash plan.
Yeah,
It's
because
not-
we don't get to keep it if we had extra. It's just a way to reduce costs for us, but it's not an interest earnings kind of thing.
So Mike has the challenge of keeping that balance to the amount that he needs for day to day, and whether or not he should be moving things over to an interest earning account. And he does
And
a real good job.
You
As
probably
long as-
heard of this, Jim, too, because some counties, it startles me that they do this, but they do it. In smaller counties, they will keep as much money as they can in their checking account in order to make sure they have no fees at the end of the year. And I'm thinking that's not a very efficient way to go about it. You know, you're going to sacrifice 5% for the 2%, so you don't see any fees. The fees are still there. Just how do you want to hide them? So.
Yeah, it's like when the previous treasurer said that there was no commissions on any of the bond transactions that we did. It's like, oh yeah, there's a fee, there's a cost. These guys aren't charities. For those of you who don't know, and I apologize if I never made this clear, Mike is our deputy treasurer. So when I am not here, he is able to do everything that I do, and he has the experience to back that up. So, and he's also can give me input if he thinks that there's something different that I should do. And we, I'm always saying this, but we work really well together. And he has my back and I have his back, you know, so in some functions, not intentionally, but ends up, I'm auditing some of the things he's doing just by having to do what I'm doing. And then he also ends up seeing what I'm doing. And if either one of us makes a slight error, the other one's going to say, hey, what's going on? And it works really well. And it's important to have that kind of working relationship when you're talking about finance. I'm sure you all know that.
Thank you, Chris.
So, yeah, no, you're most welcome.
And if I may, Chris, you know, because I'm kind of going back to the interest and bond allocation and the methodology that we were talking about there. And just in case folks didn't know, one of the reasons that we monitor that really closely and how we do the distributions back to the various funds is just, you know, in recognition of the fact that the revenues and the funds that are being invested, it's a blended within our budget. It's not all discretionary funds. It's not all general fund to where we can spend it on any activity or anything else. And so because you have a mix of Medicaid funds and you have capital funds and you have system development charges and you have gas tax revenues, all of those things are included in that investment portfolio. And the reason we do the distributions back is to make sure that we don't get sideways with any restrictions around how the funds are used or how the funds are spent. And so that's why we make sure that when we're doing the distribution of any earnings or losses, however that comes in, that it's allocated back across the departments in the manner that we do it. So, you know, just kind of recognizing that we have a mixed portfolio of restricted and unrestricted funds. And that's the reason that we have followed this distribution model for so long.
I have a quick
Good.
question. So Ken, just to follow up on that, so for instance, the restrictions on the interest for a restricted account, so if you have Medicaid or gas tax, that is not discretionary because it's interest, it becomes restricted by virtue of where it originated from.
Sometimes it varies from fund to fund, and I'd probably have to do a deeper dive into those specific funds. But there's different rules depending on the funds. You know, sometimes they do have in statute that any earnings can be used as a discretionary, but you know, historically, you know, because again, you have to be careful because it doesn't apply to all the various restricted funds. Every single revenue source or fund that we have coming in has different rules, even if it's down to you know, if we've received a federal grant for a specific project and we haven't initiated that and we're earning interest on it, Whether or not that's discretionary, any earnings on that is going to be subject to those grant requirements or those individual requirements. And so that's why the safest bet is to do the distribution the way we do it. We put it back into those funds. And then if there's questions that come up, like what to do with the interest earned, like ARPA as an example, that's when we've been using it to cover a lot of the administrative costs associated to ARPA. So we've been using those funds. There are some, there is a little bit of discretion in how we use those funds on interest earned. But then if I start getting into Medicaid funds, I would have to go into the statutes and do a deeper dive into that homework. Hopefully that makes sense.
Thank you.
Okay. I think we have covered everything that I wanted to cover. Now I open up the floor to comments, questions, suggestions. As we said earlier, I'm more than happy, and that's when this group is an important group to me. We've got some really good brains here. So, anything? Okay. Well, I'm sorry that Commissioner Johnston was not here because he was the one that wanted to talk about the way that we're managed the money, and I'm sure he would have had some input as well. So unfortunately, next time maybe he'll be here. So, okay, we done? All right, thank you, and
Thanks,
go
Val.
out. What? Yep, seize the day, as they say.
Thank you.
Thank you.
Thanks.